Matt, so good to see you. Today we are diving into 76 years of headlines, what market history teaches us about staying invested. From oil embargoes to global pandemics, the S&P 500 has endured decades of uncertainty and come out stronger over time. So let's break down the data and talk through whether pre and post retirees should make any changes to their portfolio. And I'd like to start with this chart. What stands out to you here about how the market responds to global events?
There's always a quick knee-jerk reaction to
Yeah.
market events, to the headlines, right? And depending on how severe and how long those headlines stay repeating from day to day, does make an impact on how the market reacts. But over time, the market comes to its senses and realize that the knee-jerk reaction isn't so much what's happening with the American economy and the companies. We've been through a lot in the headlines this last year. And I always tell people, if something crazy did happen tomorrow, what are you going to do the next day? What am I going to do the next day? Aaron, you know what's going to happen tomorrow? I'm going to go to work tomorrow. Yeah. Is Microsoft still going to open? Yeah. Is the grocery store still open? Yeah. Our life is still going to continue. And that's not to minimize the current events and what we're going through in the world, but it's to point out that there's a difference between the stock market, the economy, and the headlines.
Yes, of course. And that's why we're having this conversation, right? I mean, it does help us calm down, helps me calm down a little bit to look at the data, not rely on how I feel at the moment. And it's easy, Matt, again, logically, I get it. Like I see when you zoom out, it's apparent why staying the course, staying invested is often the best advice. But if I feel uneasy about how I'm invested, when is the right time to make changes to my portfolio?
Well, if you feel uneasy, the key question is give us a call, right? That's what we're here for. We do reviews with our clients. We update risk profiles. But as far as making changes, we don't want to make changes right after that knee-jerk reaction, right? Because a ball dropped, it's going to bounce back. The stock market's 2 steps forwards, 1 step back, right? You don't want to, you don't want to go to cash the day after the ball just dropped. But when in doubt, that's what we're here for. We're here to walk you through it.
And how does the answer change for someone who is nearing retirement or recently retired?
It does change, but I think the biggest question is it's not your retirement date. It's when are you going to start taking money out of your IRA, right?
Yeah.
That's the big difference because, some people have guaranteed income and they have that planned out. That's a different, and maybe they don't need income, for 5 years out of their IRAs. But that's why we also talk about having various buckets of money, right?
Mm-hmm.
We're going to have your bank money. We're going to have your Roth money. But along with that, it's not just types of buckets, like IRAs versus Roth or IRA versus Roth or traditional. It's also types of money, more conservative money to where it's not going to be, it's outside the stock market, if you will.
Right. And we're going to dive into those specifics in a second, because what you are touching on here is a risk known as sequence risk, which is what happens when people are retiring into a down market. This is a real unique challenge. So Matt, can you walk us through this, please?
Yes. So the chart we're looking at, 2 different people retired at the same time, started with the same dollar amount. They both have a 4% average rate of return, but yet one 15 years later on the left has 105,000. The other 35,000.
Wow.
The only difference is when we go up to the top and we look at year one, look at the withdrawal rate. We're both taking out 5,000, but look at the return. Year one, we made 8% in blue. We lost 5% in green. So big losses at the beginning of retirement. When your key item here is when you're taking withdrawals, can have a big impact on how long your money lasts. So sequence of return is very important when we talk about retirement planning and not outliving your money.
Right. But we have no control over what the market is doing when we retire. So how do you guard against sequence risk?
We want to make sure we have various buckets of money, right? So we're going to talk about your safe bucket, your income bucket, your growth bucket. You don't, I talk to every now and then I hear someone say, well, why don't you just put all your money in the S&P 500, right? Well, that's great when you're young and you're in growth mode. But when you get into retirement, you're in preservation and then also distribution mode. Those are 2 different modes. It's a whole different world. You need a safe bucket, right? You need your 6 months reserves. You need an income bucket. That is money that ideally it's going to be money that beats the bank, right? We're going to beat the bank. That way we're beating inflation or keeping pace with inflation. But at the same time, if the market drops tomorrow, we still have a good bucket of money where we can look at it. I call that your sleep at night money, those two buckets right there.
Right.
And the other bucket, of course, is your growth bucket. We need a little slice of the pie that when the market goes up, we go up with it.
Right. So the people who are asking, why don't we put it all on the S&P? We go back to the first chart, right? Well, if you have 100 years, yes, that's what you should do. That is, as you're mentioning, the growth bucket.
Yeah, I was looking at that .com bubble right there. If you're on the S&P 500 and then you go into retirement and you lose 30%, that goes back to that sequence of return. You just lost 30% in year one, but yet you've got to take out, you know, your 5%, your 4%, whatever it was. But that percent is not a percent for people. It's a real dollar amount that you need. And when you just lost 30% in the stock market, you're taking out way too much money, way too much.
Yeah. No, again, this is why we come back to the data to kind of understand the math behind this. And then it does make more sense and it makes me feel a little bit better. So Matt, I think like you said at the beginning, if somebody's feeling uneasy, it either means that they don't have a plan or their plan is not in line with their risk tolerance. So if they'd like to sit down with you to create that, what's the best way to reach you?
Give us a call at 425-256-3105 or email me at mberkland@choosevault.com.
Great. Again, Matt, thank you so much for your time today. I really appreciate it.
Thank you, Erin.